And welcome back to Wiser Retire Setup. Well, you've gotten about halfway through. You're just completing number 3 and moving on to number 4, net worth. So you can either click on the little arrow at the top, or if you're back in the savings, you can just go to the bottom right and click on next. Now is where we're going to have to make a decision whether we are going to add an account to what we refer to as a linked account or a manual account. So we're going to go through both examples, and the first thing we're going to do is click on right here, linked account, and this is the shortest, fastest, quickest way to get an account to pull into your Wiser Retire. Now, there are some large banks that are listed here. If you have Wells Fargo, you can click on Wells Fargo and it's going to ask for your username and password. I will tell you that most of the financial institutions are listed here, and just from experience, some of the ones you might run into a little bit of an issue with, like Vanguard, they will change their protocol. And I'll show you a little bit later sessions that when you log in, if the custodian or the bank or the brokerage company has changed their protocol, there'll be a little warning sign that you just need to reconnect it. But you can type in something like Charles Schwab, and you'll see that Charles Schwab will come up. You can type in Interactive Brokers. You can type in TD Ameritrade. TD Ameritrade will come up. And you just need to find the institution. You put in your username, password. Some of them will go through further authentication. Usually at this point is where everybody says, oh my gosh, I'm giving access to somebody else to my accounts. Actually, you're not. This is what they call 256 encrypted, AES encrypted interchange. Now, again, I'm not the tech expert, but I can tell you that it's Pentagon level security. Now, that doesn't mean that somebody still can't break in, because I tell people, look, if they can break into the Pentagon, there is the possibility. However, after talking to some Secret Service people, we find that about 95% of the issues that people have with identity theft are not through the geniuses that are needed to break into the internet. Rather, they are people that will steal your mail out of your mailbox. So let's say somebody steals a statement from one of your banks or brokerage companies. Well, first, they're actually going to get the account number off of that statement. They'll know your name, and they might know how much you actually have in that account. Here's what happens in this type of system. If you haven't connected these before, if you've connected them before to things like Quicken or QuickBooks or MSN Money, you know how these things work. If you haven't, I'll give you some assurances that this is a lot safer than the statement in your mailbox. And the reason is, when you put the credentials in, it makes the connection between this system and your bank, and then the credentials go away. Now, people ask me, well, what if somebody could actually break into this? Well, they might be able to. I mean, there are hackers out there. If they can break into the Pentagon, they could probably break into anything. The real question is, what would they get if they broke in? Nothing. All that they're going to see is you have a credit card. They're going to see you have an investment account. It'll tell them the amount of investments you have, what kind of investments that you own. This type of system is not two-way. What this system does is it will pull the data from your financial institution, but they can't move money on this system. They can't buy something. They can't send money. All this system is a reporting system. Your bigger risk is with your bank that you have bill pay set up on. If they break into your bank account and they send out a bill pay, they send out a check, that's risky. This system is not like that. They can only view it. So a lot safer. Now, this is again the shortcut, but sometimes your financial institution is not listed here, or you don't want to put it in. Now, that's fine. However, in order to get the correct tax analysis, risk assessment, and the right plan, you got to have the right data. As they say, garbage in, garbage out. Now, I'm going to show you how to add both. Linked accounts, pretty simple. Just find your company, bank, credit card, investment statements, stock plan, loans, property. It'll even find some of the property insurances. Insurances or other types of investments. This might be if you own a business. So let's just go up here. We're just going to add something like an investment account first. Now again, the difference between adding an account and linking account, I'm going to pull all the data All I got to do is that one-time investment or of just the credentials. If I hit add account, I've got to manually add everything in that account. The other downside to adding the account is nothing is going to be automatic. What I mean by that is, let's say that you hold $2,000 in cash. I'm going to go ahead and save that, and I'm going to add a holding. Now what I have to do is I have to add each holding and the number of shares and the cost basis. So if I have 100 shares of AT&T, the current price as of the date I'm putting this in is $31.23. And if your cost basis is $25, you add it in here. Now the downside to this is, let's say that you have a dividend that's going to buy more shares. This will not automatically update. Why? You manually entered it. You didn't link the account. If you link the account, all dividend reinvestment, all cash accounts, all account activity will be updated at the end of every day. So when you log in, you're looking at that current data. Now, I want to bring your attention to a couple things. One is this included in your plan? If it's included in your plan, make sure you click it on. Let's say you wanted to track something. You can do a what if this way and keep it out. But I'm going to show you some other ways at the end that you can keep it out of your plan. What might this be? Well, this might be an account that you're managing for your mother. What is a managed account? Do you have an advisor helping you with this account? If you do, click on Manage. Go ahead and hit Save, and then down at the bottom, make sure that you save your holdings. And I'm going to add another. Account just by going up to the top. I'm going to add maybe a loan, and let's put a loan in. As you can see here, it just has John's manual loan. So let's say that I took a home equity line of credit, and I'm going to include that in the plan because it is an actual loan right now. And let's say that the loan is, we're just going to call this First HELOC Bank. I don't even know if that's a real bank or not. I'm just going to go ahead and enter it in there. Let's put $15,000, and let's put that the monthly payment on that is $250. And let's say that the interest rate is 6%. Origination year, let's say it's 2020, and let's say it's a 10-year term. Okay. Now over in the where it says link to house, I've not entered a house yet, so it's just going to say default. Let me show you where that's going to come in. The balance on that is, let's say, $15,000, because let's say I just took it out and I don't want to assume an early payoff. Now, if you put it in a calendar year, it is going to make the assumption that you've got to come up with the cash, and the program is going to try to find the cash. So for right now, just put no early payoff. You can play with that and toggle that at a later time. So I'm going to go ahead and hit save, and we can see now that shows up on the net worth as a negative $15,000. Let's go ahead and enter a property. Now if I rent, pretty simple. Just going to put in the monthly rent. What if I own? Voila, all of the fields open up. So the primary home, now what I would suggest that you do, don't leave it as primary home. Just put in the street name of your house. And let's say that the calendar year of that purchase, now if you want to buy it in the future, that's fine. You can do a what if scenario here. But let's say that I did this in 2010. Let's say that its current value is $500,000. Let's say that the annual property taxes are $3,500. Remember, you got to watch out. There's some things that will ask for monthly. There will be some things that will ask for annual. Let's say that the annual insurance is $1,200. Now, what do I like to use for rental properties? I like to use 5% for rental properties and 3% for net on personal residences. We can get into why later. And let's say I put the purchase price. Now, here's what you have to be careful of. If you put the purchase price as $350,000, and let's say that you put in $50,000, so now your actual tax basis is $400,000. Now, you can enter the $400,000 here or later on when you get to the plan and maybe you want to sell this house. There's a what if scenario where you can put in, what are my selling costs? Remember, because if you buy a house for $350,000 and you put $50,000 into repairs, that is not taxable. That's considered the cost basis of the house. I would prefer that you just leave it here so we know what the original purchase price of the house was. You can play with the other adding those repairs and improvements on later. I know some practitioners that like adding in the total here. So this is your choice as long as you remember what you did. Okay? Now, who owns this? Does John own it? Does Mary own it? Or do you have the house put into your revocable living trust? So make sure you identify who is the owner. Let's go ahead and save that. Okay, let's jump into credit cards because credit cards do pose a problem for a lot of people. Let's say that I have a credit card. I'm going to call it John's High Point credit card. And let's say that I'm going to put the current balance at $15,000. It's important to know what your minimum payment is, but it's also important to know how you actually treat that credit card. So if I put a high monthly payment, and this is what I'll see a lot of people do, is they'll say, okay, I pay $750 a month on my credit card. And I'll say, okay, let me see 24 months of credit card balances. And the credit card balance hasn't changed. It hasn't gone down, which would lead to the presumption that what they're doing is they're putting additional money on the credit card. So the credit card's charging them the 10%, but then they're adding additional funds to that credit card just to keep it at the $15,000. So what we need to know is what that history and behavior is, because that 10% APR, or whatever the APR is, the annual percentage rate on your credit card, if that is, say, $1,500, we have to count that as an expense. However, if what we see is maybe the credit card balance 2 years ago was $25,000, there's no additional charges going on it, you're making a monthly payment of $750, I would enter it just as you see it here. However, if you see that the credit card is not going down, here's the way to do it. Just enter your monthly payment as whatever you're actually entering it as. So $100 is $100. That's whatever the minimum monthly payment is. And I'm going to go ahead and save that. Now you can see up here, there is a balance due, and that's a negative. Let's go down and add, we added the real estate. Let's go down and add some insurance, because this usually poses some problems for people. Now when you bring down the insurance tab, you'll see group life, term life, whole life, universal life, index universal life, and then we get into the disabilities, long-term care, hybrid long-term care, homeowners, auto, and umbrella. Please put all these in, but here's what I want to do. Please make note that if you enter them here, you don't want to double book the expenses when we get to the expense tab. So let's go ahead and just enter, we're going to call this the hybrid. And we're going to call John's Life and Long-Term Care Hybrid. What is that? That's where they combine long-term care insurance, allowing you to, on a death benefit, allowing you to utilize the death benefit if you have long-term care. But if you don't need long-term care and you pass away, then they just pay the death benefit. That's one of my favorites because I know I'm going to get my money back from that insurance company. Let's say that I'm going to add in an a death benefit of $600,000, annual premium of $5,500. Let's say I just bought it, I'm the insured, and let's say that the benefit is going to go up by 3% per year. And you have to look at the policy to find that out. Acceleration period. Well, what this means is that they're going to accelerate the death benefit for a period of up to, and you have to look, some of them might say 2% per year, up to 4 years. Sometimes you'll buy a rider. There are certain companies that will say, hey, I will allow you to extend for another 5 years past whatever that first 4 years of payment might be. So what I'm going to do is I'm going to say premium ends when? Well, if I'm the owner, if John is the owner, and maybe that ends when life expectancy ends. So remember, we put John at age 100. He is currently 50 years old. If it's 2020, I'm going to put 2070. Premium tax. So the premium tax might be if you're self-employed and you're paying for that policy with pre-tax dollars. So as you can just open up that bubble, it will explain that The after-tax premiums are going to be deductible in medical expenses on your Schedule A itemized deductions, but if it's pre-tax, it's actually going to deduct it from your salary, very much like a pension plan. We're just going to put after-tax right now, but it's important to put that because when you get to the tax assessment stage, you want to make sure you've got the right calculations in there. Inflation type. Is it going to be compound or is it going to be simple? Simple simply means they're going to add in a percent to the original base each year. Compound means that they're going to add a rate, they're going to recompute what the benefit is and add the new inflation to that new amount. So compound is going to be more expensive of an inflation type of insurance policy, but it will go up faster. Elimination period. How long do you have to wait to get the disability benefits? As most know, I'm an advocate for a longer period of time if you can afford to take that risk. The next question is are the benefits taxable? Well, here's the easy way to look at it. If you pay for the benefits with pre-tax dollars, your benefits will be tax-free or taxable. If you pay for them with after-tax benefits, your benefit will be tax-free. We're going to go ahead and save that. Next, let's go ahead and add a business because I know a lot of business owners use this program to map out some of their actual investments in their business. And let's go ahead and put that in there, and we're going to add, let's give it the good old widget company number 9. And what kind of asset is it? Well, if it was an RV, if it was something where it was a boat, something like that type of asset, you'd add it in here. Let's just do that for the heck of it. Let's just add an RV. I've always wanted an RV, so this will be fun to do this. Let's say that I don't even know how much RVs are, but let's say it's $100,000, and it's not going to grow. It's going to probably depreciate. So I'm going to put it as a negative 5% per year. And let's say that the cost basis, I spent $125,000 on it, but like any vehicle, you drive it off the lot and it's going to lose money. So we're going to go ahead and save that. And remember, you can put depreciating assets in here and decide if you're going to keep it in the plan or not keep it in the plan. And let's go ahead and add another asset as the business, because I just got a little carried away there with the RV. And we're going to call this John's widget company number 9. All right. What's the asset type? Are you holding a note for somebody? So did you sell a piece of real estate and you're holding a note back? Did you sell a business and you're holding a note back? Or do you have a business? Now, let me explain. If you have an LLC, it does not mean that you're just going to arbitrarily choose LLC. The reason is an LLC can be taxed as a partnership, as an S Corp, or as a C Corp. If you have what is referred to as a disregarded entity, this might mean that you set up an LLC and you are a one-person LLC. Now, in most states, even if you're married and you put a husband and a wife on an LLC, you are going to be considered disregarded. What does disregarded mean? Doesn't mean they threw you away. It means that the IRS is not going to consider your business in a different filing status than other than filing it personally. So when you have a disregarded LLC, it's going to show up on a Schedule C sole proprietorship on your 1040. However, you could also have an actual partnership, or you could take an LLC and request from the government that you tax it as a partnership. You could have an actual S Corp, or you could have an LLC taxed as an S Corp. You could have a C Corp, or you could have an LLC that decides to get taxed as a C Corp. So how do you choose this? Well, even though you might have an LLC, and you might have requested the IRS to tax you as an S Corp. Even though it's an LLC, I want you to choose S Corp because we're more concerned with how the program is going to tax that type of income. So what is the current value? Well, you can put any value you want, but what I would suggest is if you've not done a formal business valuation, you can visit liveplan.com, L-I-V-E, plan.com. You can do a formal business valuation there. For the purposes of your wealth journey, we're just going to put the value as $100,000, and we're going to say that it's going to grow by 5%, and you get an annual income of $15,000 from that income. Annual distribution. Now remember, if you have a corporation, an S Corp, you have to determine how much of that $15,000 are you distributing to yourself. If you're rolling it all back into the business, you're not distributing $15,000. You are rolling in 10. Maybe you take out 5 and leave 10 in. But let's determine how much you're actually taking out. So for the heck of this, let's just say that you're taking out $5,000. Now I want to bring a really important note to this, because a lot of times people will send emails into support and they'll say, hey, I put my annual distribution for my LLC taxed as an S Corp, but it's not showing up as income. Let me show you why. Amount you will receive from the business. This is reflected in cash flows, but not taxed unless also input as income. So you got to remember, you got to come back up into the income section and add in that cash flow. So we'll do that now. And let's say that the income growth we anticipate on going up. If you acquire the business or you're going to sell the business, you can add that information in. You can even add in whether you're going to get a lump sum or you're going to sell that business in an installment sale and what the cost of that sale might be. For the time being, we're just going to leave that as is, but we're going to go back to the income section and we're going to look up to see, oh, there's self-employment. And with an S corporation, even though you only take $5,000 out, if you earned $15,000, you're going to pay tax on $15,000. So see how we have that entered there? We're going to go ahead and leave that because that would sync in with what we just put in with the business. So let's go back to other, and let's just take a look at that company asset again. And here it is. We made $15,000, but again, it's reflected here. It's going to reflect on cash flows, but you got to make sure that you put in the taxable portion where it needs to go in. Okay, let's go back to one other trigger here. So we chose S Corp. Let's choose LLC, and you're going to see service income. Now you might have remembered this when we set up your income. If you have qualified business income, referred to as QBI, as long as you are as a single taxpayer making less than $157,000 or double that if you're married filing jointly, you're going to get a 20% credit, meaning you won't pay taxes on 20% of that income. You're going to get a credit back on your income. Services income refers to if you are providing the service based upon your talents. Who might that be? An accountant, an attorney, an architect, an engineer, a financial advisor. Insurance agents actually have an exemption to this. Architects, believe it or not, have an exemption to this. They must just have had a better lobby group than the other groups. So if you are service income, make sure you click that on. This way, if your income ever gets over the limits, it will start to remove that 20% credit. So watch what happens when I go to a partnership, it's still there. If I go to an S Corp, it's still there. However, I go to a C Corp, that's not eligible for a QBI, so it takes it away. Now I'm going to add one more asset which usually gets a little confusion. We get a lot of support tickets in, which is insurance with cash value. So let's take one of these, such as an indexed universal life, and we're going to add in John's indexed universal life. I'm just going to shorten it. Let's say that the death benefit is $500,000, and he's using this as a savings type of plan. Now, important is that if you have set up what's referred to as an ILIT or an irrevocable life insurance trust, make sure you put this on as the owner because it will change the taxes. Next, do you have a joint life? That means that both you and your spouse are insured, or is it a single life? Very important, because if we do a what-if scenario later on and we show John passing away to make sure that Mary can survive, If you've incorrectly coded it as joint, it won't show the death benefit being paid. So in this case, we're just going to name it as John as the insured. Let's say that the premium ends in 2070 and 100% of it goes to the beneficiary listed, insured as John. And let's say that the current cash value is $25,000. The way that we can take a distribution is either by a full surrender or a tax-free loan. We're going to put tax-free loan, and let's say that what I want to do is I want to start taking an income from this, and let's say I want to put this out at 2038. That'll be 3 years after retirement, and I'm going to end it at life expectancy. And let's say that what I want to do is, let's see, if I'm putting in $15,000 a year, let's say I want to take out $10,000 a year tax-free for the rest of my life. And I'm going to hit save. And as you can see, we've now got recorded the debt with the credit card, the debt with the home equity line of credit, the property is entered, the value, the insurance cash value is entered, the indexed universal life is here under insurance, so it totals it up into that area. And here's my business and my RV. Now let's go back up to one more area and put a loan in. Now we put a HELOC in, and let's go ahead and add another loan. And we're going to add in primary mortgage. Now you remember when I did this before, it didn't actually have the mortgage showing, or it didn't have the house to connect it to. Now I'll put this this mortgage as joint, and let's call this loan company number 1. Now I'm adding these names in here just as the example, but it's important. Name the actual loan company. Really, it will help you when you get to the end of the plan and you start looking at all the little different things that you're trying to understand. And if you've got a lot of different things going on, it helps in the organization of it. Okay, what kind of loan type is it? Is it a first mortgage, second mortgage? Is it adjustable? Depending upon what you put into this area, it will open up different fields. So let's say that the original loan amount was $75,000, and let's say I have $750 a month. Origination year, I'm guessing here, 2010. Loan term was 30 years. And the question sometimes comes up, well, what if I had draws? I built the house and I did construction draws. Well, you had a beginning date of the mortgage when it was all consolidated. Use that date as when you originated that mortgage. Now I'm going to link to the house. If you remember before, I didn't have any houses to link to. There's the house that I entered. I'm going to link it to that house. Important. This way, if you do any what-if scenarios where you want to pay off a house at a later time, that you can actually show the mortgage being canceled. And let's say that the balance now is $55,000, and I'm not doing any kind of early payoff. I'm going to go ahead and hit save, and now I've got both loans connected into the loan area of the $15,000 and the $55,000. Now this was a pretty big section, but this is primarily what you want to concentrate on accuracy in, because when you get to the what ifs of building your wealth journey, if you have taken shortcuts here and not entered all the fields, you're going to find that your wealth journey is not going to be accurate. As I say, you start out in a journey in a jungle, you want to make sure you stay on the path. I mean, there's lions and there's tigers and there's snakes and there's all these other things, so you want to stay on the path. Same thing here. There are things that you want to protect against, and you don't know how to protect against them unless you have the right data. All right, we are done. Good job. You got through section 4, net worth. Go ahead and progress on to the next section 5, expenses.